Matic price has slumped below the lower trend line of a rising wedge. A 220% gain over 8 days warrants a mild correction. Demand for Layer 2 scaling solutions puts Polygon in the driver's seat. Matic price decline below the lower trend line cues market operators for a much-needed consolidation in the hurried race for new highs. The downside should be limited as late arrivals search for a cheaper entry. Matic price solidification of early 2021 gains lays the groundwork for explosive rally. Polygon is a Layer 2 scaling solution for Ethereum by creating sidechains that run along the main Ethereum blockchain and aggregate transactions to bypass ETH's steep transaction fees and slow speed. Essentially, the sidechains increase the throughput of the system, as measured by transactions per second, enabling decentralized finance to attract more users. From March 14th to April 25th, Polygon traveled in a sideways range of approximately 60%, with the weekly closes occurring between 36 cents and 38.5 cents for 7 of the 8 weeks. It was a rare formation, but the price contraction motivated by indecision on both sides of the trade generated the energy to carry the altcoin over 200% higher. Today's bearish reversal above the rising wedge's upper trend line has carried through with a break of the lower trend line and a loss of 7.5%. The Polygon reversal was foreshadowed by a bearish momentum divergence on the 4-hour chart, as the Relative Strength Index, RSI, failed to confirm the price highs of yesterday or today. Matic price will encounter support at the 161.8% Fibonacci extension of the March to April decline at 80.9 cents, but a more legitimate level of support is 67.5 cents. A collapse below 67.5 cents alters the Polygon outlook and broadcasts an acceleration of the correction to the 38.2% retracement of the recent rally at 60.5 cents. In light of the superior momentum of the rally, it is conceivable that Matic undergoes a correction in time versus price, forcing the patience of speculators waiting for a deeper correction to engage the cryptocurrency, leading to a new thrust higher for Polygon.
Polygon supports two major types of Ethereum-compatible blockchain networks: standalone networks and secured chains, networks that leverage a security-as-a-service model. Standalone chains rely on their own security. For example, they can have their own consensus models, such as proof of stake or delegated proof of stake. These kind of networks are fully sovereign, which presents them with the highest level of independence and flexibility, but it makes it more difficult for them to establish a reliable security model. For example, POS requires a high number of reliable validators. This kind of model is usually suitable for enterprise blockchains and already established projects with strong communities. Secured chains utilize the security-as-a-service model. This can be either provided directly by Ethereum, for example via fraud proofs used by Plasma, or by a pool of professional validators. These validators are run in the Polygon ecosystem, and they can be shared by multiple projects, a concept similar to Polkadot's shared security model. Secured chains offer the highest level of security, but sacrifice independence and flexibility. This model is usually preferred by startups and security-focused projects. As we've probably noticed, the distinction between standalone chains and secured chains is even more generic than the usual split between sidechains and Layer 2 solutions that we described earlier. This allows Polygon to accommodate pretty much all possible scaling solutions.